Good afternoon, ladies and gentlemen. My name is George Chatverkov, and this is a webinar in our series of webinars covering market events as well as topical issues such as psychology of trading, fundamental analysis, and technical analysis. But today's session was we will be covering what's going on in the markets at the moment. We will focus on a more fundamental perspective, although we will look at a few charts as well to give everyone kind of an update on what's happening. And again, by all means, just stick your questions in the questions box at any point, and I will try to answer them as we go along. So in terms of what's happening this week, there has been a fair few issues that have been in effect, although the effect upon markets and currencies has not been that great. So if we actually look at equity markets and commodity markets this week, they're largely unchanged. There's been a bit of volatility and some erratic price action, but generally we're more or less where we were. There's not really any huge new developments, although there have been some things that personally have stood out for me that are, again, maybe not great factors for price action right now, but great factors to keep in your mind for next week and for the broader story kind of ongoing. Generally, markets are more like a soap opera where you really do have to keep up to date with what's happening week in, week out, and then that builds up a stronger picture for you over time, and then those trading opportunities tend to come easier. They tend to appear in front of you quite more in a much more straightforward way, rather than if you are completely coming into these markets and not keeping up to date. So for me, if we start with Europe, that's probably the most topical issue. It remains to be the most topical issue. There's still everyone's watching what's happening in Europe and throughout the banking industry in Europe, etc. For me, one of the most important things this week was the flash PMI surveys out this week, and again, the Eurozone's kind of debt crisis is still on people's minds. People are not very confident for the future, and the PMI survey is a purchasing managers index. It's essentially asking purchasing managers what their opinions are of what their sentiment is regarding the European economy, and that wasn't very good. If I actually look at just quickly what they came out as, they were generally quite pessimistic, especially the kind of the the manufacturing PMI and services PMIs. They were, especially the German ones, they weren't really that strong. And again, it just underlines what's happening in Europe, and that is essentially there's a heavy debt overhang in Europe, and kind of we are likely to see a kind of a protracted recession in Europe ongoing. So that is likely to mean low interest rates, i.e. interest rate hikes have been put back, so postponed further into the future, in my view, as a result of all that's happening now. And again, that just doesn't really help the euro out too much, especially against the safe haven currencies like the dollar, the yen. One other thing coming up today actually is in half an hour, or more or less towards the end of this presentation, what I would recommend everyone to do is keep an eye out for comments from a very important press conference being expected. So today, Merkel and Sarkozy, the German and French leaders or presidents are I've got a news conference scheduled for 2 p.m. Central European Time and 1 p.m. UK time. Now could potentially have some huge developments, or potentially could have quite a large impact upon the euro and upon generally what will be happening with the European Union. So again, that is the event risk around that will be very high, although price action may not be affected necessarily, but that is a very high event risk there. I.e., if something does happen, it will be significant. If something happens. One other, staying with Europe, one very huge, probably the most important bit of news, and again, didn't cause a lot of price action yesterday, but is likely to cause kind of nervy market views and kind of very uncertain kind of market behavior, and that is the less than, well, not so good Bund auction yesterday. The Germany auctions bonds on a regular basis to the market, and if the amount of demand for those bonds is not equal to the amount of supply, i.e. the one issued by the Bundesbank, by the German finance ministry, then it doesn't really. Then there's a kind of the Bundesbank has to step in and take the rest of that excess supply. Now, what does that mean for market psychology and market behavior? Well, if market participants can see that there's not so much demand for German bonds, i.e. that could be for several reasons, but if it's for the most likely reason, i.e. that even Germany is now starting to see the effects of certain uncertainty and people not really, even Germany is losing its safe haven kind of appeal, then that would be very, very huge ramifications for the rest of Europe. If the strongest member of the European Union is not able to fund itself and not able to attract enough foreign capital, enough demand for its debt, then how do the rest of other countries expect to do so? That is essentially the question now. The reason why we didn't really see a lot of price action on the back of it yesterday is because this was although it was the worst bond auction in German's history, it wasn't the one of many. It was just the first one. So for me, huge focus will now focus on the next. What will happen? Will go on the next bond auction in Germany, and I'm going to, for me, first thing this morning, I'm going to be looking at where that's going to be coming out, and what other auctions will be around that time, and also what kind of expectations people will have for that. I.e., will there be kind of a rebound in the next auction to make up for this one? I.e., was it just simply that the US on holiday today, and generally going into year end, there's not so much demand for safe haven debt, or is there actually something more substantial there for us to look at and potentially to react to? So again, that'll be very interesting, and that's something that was in the news this week. One other thing is today's US holiday today. It's US Thanksgiving, so kind of generally flows and liquidity and volatility are kind of low today, and you probably won't see any kind of significant equity moves or generally any kind of asset price moves today, unless we have a really kind of a factor come out of nowhere. But again, that's worth bearing in mind. Staying within Europe, we're just kind of moving over to the UK now. For me, the UK is again it's very kind of downbeat situation for sterling, and yesterday UK growth was left unrevised at 0.5%. But for me, the breakdown was actually very important. So although the expectation number was more or less within expectations, we didn't really see a huge move in UK assets or sterling. But we did see kind of the breakdown wasn't that great. So most of the actual growth that we saw last quarter was actually based on stock building and government spending. So the government support for the UK economy is still significant, and also things like inventories are, i.e. companies raising inventories. That's also part of the GDP makeup. So for me, this is not really those things like consumer spending remain low, and the levels of investment remain low. So the amount of house buying remains low. So the actual true, well, I wouldn't say true, but kind of the truly kind of significant aspects of the UK economy are not recovering sustainably, and what's actually maintaining the meager recovery that we're kind of seeing is it remains to be government spending and things like stock building, inventories, and so for me, this is the private sector is not stepping in, and that's just underlining what I was saying in previous webinars and previous presentations, and that is that for me the problem in the UK is domestic, and so it's not really export led or anything like that. It's actually a domestic problem, which is likely to lead to kind of a more further deterioration in the UK. In the worst case, and in the best case, a kind of a stagnant, kind of bobbling along the seafloor kind of recovery, where we remained around 1%, 1 to 2% growth, and potentially even dipping into negative growth, a quarter there, a quarter here, and very, very unbalanced and very kind of very meager, very anemic recovery. That's kind of what we're likely to continue seeing. Monetary policy in the UK remains very dovish. Quantitative easing is still likely to rise, according to most of the expectations that I've seen. And if we actually look at the minutes of this, the other thing in the UK I was going to mention is that this week we saw MPC or Bank of England minutes, and again that supported last week's dovish inflation report. So it's suggesting that there'll be further quantitative easing, and so for me it doesn't look like the committee will be into planning to announcing more purchases, and again. Although they are not likely to re-engage quantitative easing and actually increase quantitative easing for the time being, nevertheless, the outlook is very dovish in the UK, and so my personal opinion is quantitative easing will probably rise a bit more. This isn't 275 billion. I don't think it is. the end of that story. So I think we are going to likely to see more and more in the future, and that just kind of is likely to maintain sterling downtrends against the yen, for example, primarily, and generally sterling was going to likely to remain weak. Against the euro, for example, not so much. I mean, again, the problems in Europe are counterbalancing the problems in the UK. So, the kind of the joke that traders like to talk about the euro and GBP is at the moment is kind of the ugly sisters currency pair, where kind of they both have as many problems with each other, and so kind of seeing very erratic ranges right now. And for some traders, for some trading strategies, it's actually been very good currency pair to trade. A lot of scalping strategies are actually working very well in euro sterling right now. That's because we're not really seeing any trends. We're just seeing kind of erratic price movements on an intraday, intra-week basis. And again, that's for some trading strategies, has actually been a great currency pair. And then the backdrop to that has obviously been the similar monetary policies in the UK and Europe, and the similar kind of outlook, i.e. very quite negative outlook in both regions. If you actually move over to Asia, actually see what's happening in the kind of Asian markets, and again, the big story out of Asia this week is kind of the unexpectedly weak kind of manufacturing report in China. Again, more signs that the Chinese economy is slowing quite sharply, and we could actually potentially see, we used to seeing, these days, used to seeing kind of 7 to 10% growth in China, if not 10 plus percent growth around 2006, 2007 in China. So we could see like a very sharp kind of move away from those kind of double-digit growth figures. And so even though they're growing very strongly, the fact is that if they do stop growing as strongly, that's likely to have an effect. And that's likely to affect most is things like commodity currencies and emerging markets. So essentially, markets like Japan, Australia, New Zealand, generally markets which are linked to commodity currencies and commodities themselves. China is a huge commodity importer and a huge exporter of manufactured goods. So generally, the Chinese economy, when that changes pace or when that changes policy, that is likely to have a huge impact on many other things, such as currencies and most other asset classes that are linked in that region. And so this week, what we actually saw is that, for me, we're starting to see kind of initial indications in China that we may actually see a return to dovish monetary policy. So they've been actually very, very hawkish for the past year and a half, looking to raise interest rates, raise discount rates, and generally keep a cap on inflation and rising house prices. Now, that is starting to tail off now, and that effect is starting to tail off. So some would argue that what the Chinese National Bank did over the last year and a half has actually worked. They've prevented inflation from rising too strongly, from the Chinese economy overheating too much. So now they're actually looking to balance it towards the dovish side and prevent any kind of significant downward effects or negative effects in the developed world to affect their economy and their rate of growth. So we may actually see monetary easing, or let's say a pause in the hawkish stance they have, and that is likely to affect. For me, the biggest one is the Australian dollar. The Aussie dollar, I think, is probably the most sensitive currency to China at the moment because of the commodities, import and export of commodities between China and Australia. And if we just have a look, let me just try and find the exact figure that we saw. So let me just have a look. If I just show you here. And again, I will always try and refer to kind of websites most of you will be familiar with. So for me, Forex Factory is one of my favorite websites. To just have a look at a calendar, see what's out, see what's out this week. And as you can see here, last night, there you go. There's the manufacturing result I'm talking about. So we've got the flash manufacturing PMI, and as you can see, if we stretch it forward. If we actually stretch it back, you can see that this kind of reading of 48 is actually one of the lowest since for quite some time, and since this year. And so for me, what that really tells me is it's actually quite out of character. And if we combine that with other manufacturing PMI surveys in other countries that are also showing weakness, it's not much of a surprise for me. Now the thing is, in China, it kind of matters more in some ways, i.e. because we analysts and market participants, market watchers, they kind of know that when Chinese kind of figures move out of line, the Chinese National Bank tends to respond quite quite quickly. It's quite a reactive central bank, and that's so for me. Although we're not likely to see any interest rate cuts in China until well into next year, potentially maybe Q2 of next year. It does kind of show that if China begins to slow down, that's going to have an effect on equity prices generally, on risk generally, the risk profile for in FX and other markets. So what is that likely to mean? Well, so if China does begin to slow down, begins to and that is met with other slowdowns around the world, that's likely to mean equity price declines and, again, more negativity in the developed world. Although, on the other hand, if the China National Bank respond quite quickly and begin to cut rates quite, very soon, let's say even before the end of this year or the start of 2012, then market participants generally are forward-looking or very forward-looking. So if there is an interest rate cut expected and it's quite certain, that's actually going to have a boost for equity prices and commodity currencies, etc. So for me, the key here is not necessarily what's happening in China, but how people will react to what's happening in China. And for the time being, the expectations are slow. Well, I mean, we've only had an initial indicator yesterday, but already this week, that's what people are thinking about. So next week, it'll be very interesting for me is what the expectations are amongst traders, amongst market participants of how the Chinese National Bank is going to respond. Is it actually going to turn dovish? Those are the actual expectations, or is it actually, or will they be in wait and see mode? And that essentially nothing is going to happen until maybe something further down the road, maybe next year. So I think for me, this is going to be a very key issue. And if the Chinese National Bank does begin to ease, that's going to have a huge effect. Again, that's going to have a probably effect on yuan. That's going to make it harder for the Chinese National Bank to keep the yuan rising slowly, etc. So I think it's so. For example, if the Chinese National Bank start to cut interest rates, it's going to weaken their currency even more. That means they're going to have to work even harder to keep their currency rising slowly, which is what they're trying to do at the moment, trying to make the currency rise very, very gradually against the dollar for political reasons, also because they've kept it weak for many, many years now, to their advantage. So I think all these things are kind of added into the mix. So always remember there's a political aspect to every economic aspect. And so also remember that there's actually a political process in the US at the moment to reduce budget deficits and also there's an election cycle soon happening there as well. So, I mean, all these kind of things will begin to fit in. I mean, but that is obviously more longer term. So for me, in the shorter term, it's very important to watch kind of what's happening with bond auctions in Europe and generally PMI, as we talked about today. And again, for me, most important is expectations, what's happening to monetary policy and what people think will happen next in terms of how central banks will react. So if we actually look across the developed world, policy has now gone towards the dovish side. So if we look at UK, Europe, US, they've actually gone quite dovish. Whereas let's say a year ago, well, we expected quite I remember the exact words by some of the central bankers were quite, quite a slow but steady recovery, and these kind of phrases. Now it's more like we hope to see maintain a recovery, or may even hope to just maintain a stagnant recovery. So, i.e., the way it looks to me is we're likely to see a return to recession in many of the developed countries. I.e., like a double-dip recession, essentially, for me is going to prove to be the case in many countries, such as for me the UK, probably not the US, but UK and Europe. I think, given their extremely low levels of growth already, and UK some people were thinking it would actually dip into negative territory this quarter already. So last quarter, Q3. So I think for Q4, potentially we may see a slight dip in UK. But again, that's something for the future. Okay, so I think that's more or less wraps up the round. I mean, if you, we'll take a look at. I did promise you everyone to have a look at a few charts, so we'll just have a look at a few charts to see what's actually happening in real terms. Some of these currency pairs. I did mention the Aussie dollar. So if we just have a look at Aussie dollar against the US dollar, as you can see, this is a daily time frame. So as you can see, we've had kind of over the past, this is starting this week, so today's date here, 24th, you see a kind of small green candle here. But as you can see, for the majority of this week and majority of last week, again, we've been seeing decline. So safe haven flows up in the predominant flows this week. And again, for me, for example, in this currency pair here, we are kind of we're not really going anywhere, I would say. I mean, Aussie dollar, US dollar, if we see, let's say, from even from, let's say, let me just have a look. So from the middle of this year, so middle of 2011, we've not really gone anywhere. We're still trading around parity in Aussie dollar, US dollar. Kind of seen the highs around 110, we've seen the lows around 0.94, but already more or less trading in the same place, and that's just, again, just reflects the duality of markets at the current time, or for the past 6 months. So no one really knows where we're going. Is Europe going to get better and thus buy the Aussie dollar against US dollar and recovery is good and we're going risk on, or is everything going to turn around? We're going to see some defaults and we're going to see maybe to some extent a repeat of 2008, where several banks, several countries are getting kind of financial trouble and have to get more bailouts and downgrades, etc. So this is the kind of aspect we're seeing, and that's why if you look at this just on a weekly time from now, we'll see a few weeks of upside moves and then a few weeks of downside moves, and again that's more likely going to repeat itself over and over as it has been doing for the majority of the second half of this year. So just a little aspect for you there. A very interesting currency pair for me is actually dollar-yen pair at the moment. So, I mean, this week we've not really seen any huge developments in that one. We have kind of seen quite a lot of dollar buy action yesterday, quite unexpected. As you can see, we kind of, a very interesting thing with dollar-yen at the moment is obviously intervention. So if you can see, if I can just annotate for you quickly, if we just put a line there, if we put, we just put several lines. These are the lines, the red lines I'm putting in here essentially are the vertical lines there are bouts of intervention. So as you can see, whenever the Bank of Japan intervenes, you can see there's a huge initial reaction to the upside, but then eventually the markets start to come down very, very gradually because the Bank of Japan is going against market forces, going against fundamentals. And simple fact of the matter is they just don't have the budget to do that. They simply don't have the capital to keep this currency pair moving higher as a trend over time. They just don't have the power to do that. So what they can do is have an initial buy action, take it maybe 300 to 400 points higher, but then market forces come in with sell orders. The general trend is sell dollar, buy yen. Generally, the safe haven is more the yen than the dollar, and generally the confidence in US dollar is comparatively lower. The fundamentals for Japan are just simply stronger for the time being, and generally we're seeing the sort of lower dollar and a higher yen. And so as you can see, the last bout of intervention we had was, let me just get the exact date for you here. It was there, so 31st of October, and as you can see, we're starting to come down now again. And my personal opinion is that when we're going to, if we kind of saw the same effect here, we saw the same effect here, and we potentially could see the same effect at some point in December of this year. Why December? Well, generally markets, FX markets, and generally most asset classes tend to see a fall in December. You generally see lower trading activity in December, less liquidity, and so on less liquid markets, we could see a push down towards 76, 75 in dollar yen, and again, a very quick bout of intervention from Japan is likely to happen. I mean, if they defended this level twice, they're likely to do so a third time, because their policy hasn't changed. Fundamentally, their comments in the market haven't changed. What they're thinking about their domestic economy, the comments they're coming out with month in, month out, they remain the same. So I think the latest research I saw on the Bank of Japan kind of intervention is that they've done around half of the total amount. I think they had about $250 billion worth of intervention capital. I think I saw from JP Morgan. It was a piece of research I saw from JP Morgan. And the kind of after these three bouts of intervention, they're more or less left with around 50 to 60 billion left. So I think they've done more than half of their total budget for this particular policy, for this policy of intervention. And the way they work that out is they just simply look at central bank data released by the Bank of Japan every month. So they by law, they have to release a document, or their balance sheet essentially, at the end of each month to show what they've done with various aspects of their balance sheet, what they've done with various capital, what they've done with intervention, where essentially their funds and holdings have gone. And through the process of elimination, the process of deduction, you can actually work out how much intervention was done, because we all know what day it happened, which month it happened, and it's more or less fairly straightforward, although there is a margin of error, fairly straightforward to work out how much intervention was done. And I put my personal view that this is likely to happen at some point in December, or maybe even towards the end, maybe even this month. But and then again, for me, the strategy there is, if we do see something like that, instead of trying to work out the day that's going to happen and trying to buy this currency pair and then get out for a profit here, what's more a better strategy in my view is to actually wait for intervention to happen and essentially just have rest orders above the market, so 200 to 300 points above the market, looking to go short when the market does actually get bought up. And so essentially what that's going to do is most of the experienced traders are trying to do that, because they know that getting on the back of a upside move essentially is very difficult, because you don't know when it's going to happen. It could happen any time, especially Bank of Japan intervention, which can happen at the middle of the night in Europe. So it's daytime in Japan, it's nighttime in Europe, and so around that time that could potentially happen. But that's not a very efficient strategy to wait for. You're more likely just to buy somewhere on the high there and actually be stuck long on the top of the market, rather than actually look to go short at the top. And that's generally the intervention. I've done a couple of presentations about intervention in the past, and quite a lot of research on the subject. And the strategy that works best, or statistical analysis shows the best strategy that works kind of for trade intervention is generally selling into it, or if it's a buying intervention, and buying it if it's a selling intervention. The key, though, is obviously it's a risky strategy. No matter what, trading intervention moves is very risky anyway, regardless. So I mean, you will have to be very careful with all this if you do decide to trade that. Just be careful. Okay, guys. I mean, I think more or less wraps up what I have to say on. We've had a look at a couple of currency pairs. We've had a look at more or less what's happened this week on some of the fundamental news, etc. So if you don't have any questions, I'll wrap it up there. But if you do, by all means, put them in the questions box, and I'll answer them for you right now. So let's have a look if you have any questions. Okay, well, I don't seem to be having any questions through. If you do have any questions, by all means, email them to us, and I will answer them for you at a later date. And in the meantime, well, good luck with your trading, and always remember to kind of keep an eye on risk. We have kind of last thing before I go is keep an eye on volatility, and keep an eye on implied volatility. Generally in FX, if you're trading FX, implied volatility is very key. It's something I would recommend that you keep a constant close eye on, and generally we are kind of in erratic market conditions right now, so just be careful that the kind of the risk we're seeing, the price moves we're seeing in the markets, although they're not that erratic right now, maybe today, yesterday, and this week, generally last week and the week before have been insanely volatile and very, very, very unpredictable. So it's generally you have to be very, very careful. And so one other thing is all Alpari clients have access to Alpari Squawk, and I would recommend that you just visit our website, go to the research section, and have a Squawk open at all times. It will inform you of all the latest announcements, bond auctions, the results of those bond auctions, expectations, sentiment,